Welcome to the Deep Dive, where we cut through the noise of earnings calls to really understand what's going on. Today, we're digging into a pretty significant call from a major player in Latin American e-commerce and Fintech. This was just after market close, August 4th, 2025. And honestly, the headline numbers were a bit of a mixed bag. You had this great revenue growth, but then a surprising miss on earnings. So what's the real story?
Yeah, that's exactly what we're here to figure out. Our mission today is to unpack why those numbers landed where they did. We'll look at the key financials, dig into what management is prioritizing strategically, and how the market reacted, right out of the gate. So by the end, you should have a much clearer picture of what's really driving things.
Okay, let's jump right in with those headline numbers. Top line growth looked, frankly, pretty impressive. Revenues climbed, 34% year over year, hit $6.79 billion. That actually beat expectations, which is good. But, and this is the big but, the earnings per share figure really stood out. Diluted GAAP EPS came in at $9.90. Which is actually down 6% compared to last year, and quite a bit lower than the $11.50 consensus estimate Wall Street had. That's a noticeable miss.
It really is. And putting some other numbers around that.
Yeah.
Operating income, it grew, 14% to $825 million. Mm-hmm. Solid.
Yeah.
But importantly, the operating margin squeezed down by 210 basis points year over year, landed at 12.2%.
Right, 2.1 percentage points, not insignificant.
Definitely not. On the volume side, though, things look strong. Gross merchandise volume, GMV, up 21%. And total payment volume, TPV, that surged 39%.
Right.
Really powerful growth there.
Okay.
But as you mentioned, that EPS miss definitely colored the initial reaction. We saw, some real caution from investors, immediate pressure on the share price and after hours.
Right. Okay, so let's unpack the why. Management talked a lot about strategic margin investment, didn't they? Especially on the commerce side. What exactly does that mean? What are they doing that's hitting margins down? What's the supposed payoff down the road?
Well, what's really interesting is this move they made in Brazil back in June. They cut the free shipping threshold. And this wasn't just a random decision. It's framed as a deliberate investment. They want to get people buying more often, increase their market share.
And they saw results from that already?
Apparently so. They mentioned June unit growth accelerated to 34%. So the idea is, you take a hit on margin now, but it brings in more business, boosts that lifetime customer value, and crucially, builds a stronger defense against competitors. Mm-hmm. We're talking Amazon, Shopee, Temu. They're all pushing hard.
So they're consciously sacrificing some short-term EBIT, earnings before interest and taxes, for those longer-term gains. But isn't there a risk? Like, you cut the free shipping threshold, people get used to it, and then it's really hard to pull back. You end up in this margin race to the bottom.
That's definitely the worry you hear from some corners of the market. Absolutely. It's a fair point. But management points to their logistics network. They handle a huge chunk of their own deliveries, right? 57% regionally, over 75% in Mexico, and they're hitting record same-day, next-day delivery rates. So that efficiency presumably helps offset some of the cost.
Okay, that makes sense.
Plus, they tweak seller fees. They talked about smoothing out cliff effects, where a seller suddenly pays much higher fees just for crossing a certain sales level. Mm-hmm. They're trying to make it more gradual, especially for items in that 79 to 200 Brazilian real range. Mm-hmm. The idea is to encourage sellers to list more stuff, keep prices competitive.
Right.
So, maybe some specific low-priced items do lose money on their own, but they expect the overall effect, happier customers, buying more often, sticking around longer, to be a net positive for the P&L long term. Mm. And they did say they've done this kind of threshold reduction 3 times before, and it's worked out. So there's some precedent.
Okay, so a calculated gamble on the commerce side. Meanwhile, the fintech arm, Mercado Pago, just seems to be on fire. User growth keeps climbing 68 million monthly active users now. And the credit portfolio, up 91% year over year, $9.3 billion.
It's massive growth.
And the credit card specifically, even faster, up 118%, and they issued 1.5 million new cards just in Q2. That kind of explosive growth, though, immediately makes you think about risk, right? Asset quality. How are they managing that?
That is the absolute key question whenever you see credit growing that fast.
Yeah.
And the news there was actually pretty encouraging. They reported improving metrics. Things like NPLs, non-performing loans for loans between 50 and 90 days past due. Those actually fell below 7% for the first time.
Oh, interesting.
And the 15 to 90-day NPLs also came down compared to the previous quarter. Mm. Now, the longer-term NPLs, over 90 days, they were more stable, around 18.5%.
Okay.
But here's a fascinating detail. Over half of their Brazil credit card portfolio is now NIML positive.
Net interest margin on assets.
Exactly. So being NIML positive means Those newer groups or cohorts of cardholders are actually generating profit now, even if the overall needle for the whole credit card book is still lower than their other loan products.
Why is that? Just because it's growing so fast with new, initially less profitable users?
Precisely. It takes time for a new credit card customer to become profitable. So the fact that over half the Brazil book is already there suggests the underlying economics are improving. Their strategy seems to be pushing card issuance hard in Brazil and Mexico, but keeping an eye on payback periods aiming for roughly 2 to 3 years.
Got it.
Oh, and they mentioned Argentina too. Credit growth there is coming off a really low base. And there were some changes to reserve requirements for money market funds that slightly reduced the rates they could offer. About 2 percentage points, they said.
Okay, so commerce investing, fintech booming. What about advertising? That's often talked about as a future profit engine. It grew 38% year over year. What's driving that? They mentioned a Google Ad Manager integration and AI.
Yeah, this is definitely one to watch. That Google Ad Manager integration, which happened back in April, is quite important. It basically lets them sell ad space beyond just their own marketplace. It opens up a much wider inventory, moving them more towards being a broader ad tech player.
Right, tapping into the wider web.
Exactly. And analysts are starting to get quite excited about this. Some think ads could become such a strong, high-margin business that it could potentially offset that drag on EBIT from the logistics investments within, say, the next 2 years.
Wow, okay. That's a big statement.
It is. They also mentioned strong performance in Argentina specifically, helped by better macro conditions there, lower inflation, sellers having more stock, but also just good execution by their team in selling the value of advertising.
And the AI part, how does that fit in?
Management seems quite bullish there too. They see AI helping in a couple of ways. One is making marketing itself more effective, like automatically generating lots of different ad creatives to test out for branding campaigns. The other is optimizing the ad spend itself, helping sellers get set up with the ad tools, they called it ad stack onboarding, and using AI to help them bid more efficiently, get better returns on their ad dollars, basically making it easier and smarter for sellers to advertise.
Makes sense. So putting it all together, lots of investment, lots happening. Did they give any specific guidance for fiscal 25? I noticed that seemed absent.
Yeah, no specific numeric guidance for the full year 2025. That wasn't too surprising given the moving parts with the Brazil investment. But the CFO did say they expect margins to normalize once those shipping promotions annualize, meaning once they've been in place for a full year.
And normalize means back to previous levels, or?
Well, they didn't give a precise number for normalize, but the CFO did pledge to keep operating margins north of 10%. So that provides something of a floor.
Okay, a floor at least.
And a pretty big piece of news, a leadership transition. Founder Marcos Galperin is moving to executive chairman, and the current commerce president, Ariel Szarfsztejn, is set to take over as CEO effective January 1st, 2026.
Okay, so continuity, presumably, given he's an internal promotion, but still a new era.
Exactly. Signals continuity and strategy, but definitely marks a new chapter. Oh, and one other factor, helping them balance all this growth and investment, they got that S&P credit rating upgrade back in July to BBB.
Right, investment grade. That helps with funding costs, I imagine.
Absolutely. Lower funding costs make managing this balancing act between investing for growth and maintaining profitability just that little bit easier.
Okay, so let's bring it back to the investor perspective. The market reacted negatively, at least initially, to the earnings miss. Shares went down. But management sounded, as you said, cautiously bullish. Why the disconnect? Is the market just focused on the short term, or is management maybe painting too rosy a picture?
I think it really boils down to that classic tension. Short-term pain versus potential long-term gain. The market seems to be looking at the margin compression now from these investments, particularly the shipping in Brazil, and maybe pricing in that pressure lasting for a while.
Okay.
Management, on the other hand, is framing this spending as absolutely essential. It's strategic. It's about building that long-term value, defending their turf. They're emphasizing lifetime value, not just this quarter's profit. And, it's interesting. Wall Street analysts often do get hyper-focused on the immediate quarter. They see the margin hit now and maybe discount those future benefits, even though, as we noted, this company has run this invest to grow playbook successfully before.
Right, context matters. How has the stock actually performed beyond the immediate reaction?
Good question. If you zoom out a bit, yeah, the 1 month return was negative, down about 8%, but look at 3 months, it's still up 16%, and a 1 year return, up 34%. That actually significantly beats the NASDAQ 100 over those same longer periods. So despite this quarterly wobble, the broader trend has still been pretty positive.
That does put it in perspective. What about the competitive landscape? Is it still a battleground out there in Latin America?
Oh, absolutely. The overall e-commerce market in LATAM keeps growing nicely, high teens probably. But yeah, competitors like Temu, Shopee, they're still very aggressive on price, and you always have FX volatility, currency fluctuations as a background factor in that region.
And any regulatory clouds on the horizon, especially with that booming fintech and credit business.
Yeah, that's something to watch. There's definitely increasing regulatory scrutiny around buy now, pay later schemes, and just general credit card growth across various markets. That could certainly impact the fintech side down the line.
Okay, so lots for investors to track. What are the key things people should be watching for in the coming months?
I'd say a few key catalysts. First, the holiday season results, specifically the margins they report for Q4. We'll get those earnings probably early February 2026. That'll be a big proof point. Second, more data on how well those new users acquired through the Brazil free shipping cuts are actually sticking around. We might get clues on that cohort retention in the Q3 letter, maybe around November this year.
Okay.
Third, obviously, the CEO transition itself in January 2026. How smooth is that handover? Does the messaging change at all? And finally, keep an eye on any news about potential bank licenses. They've talked about wanting them in Mexico and Argentina. Getting those could really unlock new growth avenues for fintech. So yeah, it's all about watching that balance between the volume gains they're chasing and the impact on margins.
Definitely a balancing act. All right, let's shift gears slightly. It's time for our This Is Not Financial Advice segment. Remember, this is purely a thought experiment, stretching the possibilities based on what we've heard. Absolutely not investment advice. What have you got for us?
Okay, so here's an outrageous, but maybe plausible idea, playing devil's advocate against that short-term market pessimism. Given how the market seems fixated on the immediate margin hit in Brazil, and maybe underappreciating the long-term value being built there and underestimating the power of that accelerating fintech flywheel, consider a highly speculative out-of-the-money call option spread, targeted for, say, mid-2026.
Okay, options. Risky by nature. What's the thesis?
The thesis is multi-pronged. One, the Q4 holiday season results, coming early next year, surprise to the upside. They show much better user retention and engagement from those Brazil shipping cohorts than the market currently expects. Two, the fintech side keeps showing improved profitability, especially in that big credit card segment we talked about. The mind story gets better and better. Three, the advertising business starts to become a much more visible contributor to profits, maybe even sooner than those analyst estimates of 2 years. It becomes a clear, high-margin lever.
And the timing. Mid-2026 coincides with?
It coincides nicely with the new CEO having been in place for about 6 months. That transition could provide fresh momentum, a chance to really hammer home the long-term strategy. So the outrageous part is betting that all these factors converge, forcing the market to rapidly reevaluate the stock. To look past the short-term margin dip in price and the compounded long-term value, it's basically a bet that the scaled growth with fintech flywheel story wins out over the current skepticism and wins out faster than people think.
Interesting. A bet on the narrative shifting significantly. Okay, definitely food for thought and definitely not advice.
Yeah.
So let's wrap up this deep dive. Key takeaways for me. A company clearly willing to invest aggressively, even sacrificing near-term margin, particularly in commerce, based on a belief in long-term customer value and competitive positioning.
Right. And alongside that, you've got this incredibly dynamic fintech engine that's not just growing fast, but also showing signs of improving profitability, plus that emerging potentially high-margin advertising business.
But all balanced against those immediate margin pressures the market is focused on, and of course, a major leadership change coming up.
Yeah, and I think the critical thing for anyone watching this company is to try and distinguish between those immediate, sometimes noisy market reactions and the potential long-term impact of these strategic moves. It really takes critical thinking, looking at it from different angles. Will those new customers stick? Can they keep credit quality high? Those are the billion-dollar questions, really.
Absolutely. Well, thank you for joining us on this deep dive. We hope this breakdown was useful. We encourage you to keep exploring these complex dynamics. And just a final reminder, everything we discussed here is purely for educational purposes. It is definitely not financial advice. We'll catch you on the next one.